Alright, so hi guys, welcome back. This will be part two of the four-part series where I look at the four big banks of the US market. So the stock that I'll be covering today is Wells Fargo, and the stock price as of me recording this is $29.08. Also, if you do enjoy this, consider subscribing. It's free and it really helps a lot. Anyway, let's just get onto this. So Wells Fargo, my thoughts. So I believe that this company has been hit very hard by COVID, and because of this, it is poised for a very good recovery play over the next year or so. And I think out of the big companies that have been hit quite hard by COVID, it's probably going to be some of the highest post-pandemic successes, especially out of the four main banks, which have also been hit quite hard. So this stock is down 46% year to date, but this is also with it being one of the strongest companies, both financially and based on how much control and power it has in the market. And because of the stock price being hit quite hard, I believe it is very undervalued. It trades at around $6 to $7 below the book value per share, which is close to 30% of its entire stock price. And because of this, it makes a really good asset play stock to buy for the long run, especially with the financials being quite similar. While the stock price was trading $50 pre-COVID, and now it's sub 30. So recently, in quarter two, it was hit quite hard and made a $2.4 billion loss. However, it once again became profitable in quarter three, where it jumped back into the green. And because of this, it has recently got a lot of positive attention from investors, because its revenue and profit were both up over 100% compared to what it was previously when it was hit hard by COVID. And the bank also, with a slightly different aspect to leadership, it's basically changing its business model kind of by cutting down costs and increasing its asset base. And I'll touch on this later about what the CEO is doing to kind of help this company recover from its losses. So the over scrutinization. So since 2016, this company has come under very high scrutinization in almost everything they've done, and any slip up that they've had has caused them to massive drops in the share price. And this is exactly what we've seen this year. So because the banking sector as a whole has suffered due to this, the over scrutinization, especially on this one company, has dropped the stock close to 50%. And I believe it will be like a blessing in disguise, because of it dropping down close to 50% year and being one of the strongest companies. It's trading at a very steep discount. And you would think that if it was trading at such a steep discount, it would have more traction or more people would be talking about it. But many value investors have decided to kind of skip over this stock because the data that they've basically been using has been highly skewed over the last year or so because of the losses this company's made. And because of this negatively biased data, the company's PE ratio or earnings expectations, all of this seems to be a lot worse than what it actually would be. I'll talk about this later, but simply, they've decided to ignore the last 9 to 10 years of solid growth, on top of it being one of the strongest companies in the world and in the US especially, and have kind of reduced its entire future scaling or future expectation based on what has actually happened over the last 6 to 7 months. So I believe that is not an accurate representation of where the company stands right now. So the positive outlook of this company and the future actions. So as I mentioned previously, there's been a quick turnaround from quarter two where it had a $2.4 billion loss, and quarter three, and this has probably been because of the change of the company's model. And because of this, its revenue is up 118% and its profit is up 86%. And the CEO has planned to cut down annual expenses by 10 billion and quotes he wants to trim down the company to its core business model. So basically what it's doing is it's been closing off unproductive branches, and has also set up plans to sell the asset management division of this company. And because of this, it may kickstart a faster growth and a higher return on equity because they'll be spending less and making a greater return on investment, because they will be having more productive bank branches up and running. So this idea has seemed to be resonated quite well within the company, and we can see this with its stock price up 20% over the last few months, last month itself, and the revenue and profit being up over 100%. each. It also has a very healthy asset base of 1.92 trillion. However, this does slightly exceed the US max of 1.85. However, it's not too big of a deal as of right now, I'm pretty sure. So the entry price. So for calculating the entry price of this stock, I've decided to skip over the fact of the 2020 data. As I mentioned, it's quite heavily skewed because of the losses that it made. So just to figure out an entry price, I've taken from 2010 to 2019 data to kind of predict where the stock will be in the future and where we should be buying it right now. So the earnings per share has compounded year on year since 2010 to 2019 of an average of 7.86% year on year. And by putting this average EPS growth into the future, you get in 9 years' time, once again, you get a future EPS of $8. And on average, the PE ratio has been close to 15, once again, excluding the 2020 data. And just plugging in the the PE ratio multiplied by the price, and you get a future price of close to $120. And if you want to have a minimum yearly rate of 15% compounding, which is 33% better than what the S&P 500 is doing and is much better than the savings rate of 2% as well. There you get an entry price of $34.11. And this also lines up with the book value per share of $38. So you can see by both metrics, both by just calculating the entry price or just simply looking at the book value per share, you can still see by both metrics it is an undervalued stock, and by a certain margin as well. So let's look at the financials of this company, because I mentioned this is a strong company, but we need to evaluate whether it is a strong company financially or is it just a really big company that everyone just believes is strong. So the earnings per share is 39 cents in the trailing 12 months. However, once again, as I mentioned, this data was skewed and has been regularly over $4 since the beginning of 2014, barring 2016, where it was around $3.90. So that's consistent earnings per share, and it has also been slightly growing since then as well. So that's a good outlook. Its dividend is 1.4%, and this is with the stock price going down and them reducing their dividend by 80% as well. However, pre-COVID, it was around 4% and had a very healthy payout ratio of 40%. So for those of you who don't know, this company is well known as a dividend stock, where it's slow growth but provides decent payback on investment through monetary gains that it gives back to its investors. So pre-COVID, it was close to 4%, which puts it in like some of the top 25% dividend payers in the US based on percentages. And because of that, I still believe that the dividend is there and the company has the money to sustain it as well. So I still feel like the dividend is set to grow in the future. And its book value per share is $38, which I already mentioned previously. With the stock price trading at 29, you can see that is significantly undervalued as an asset play stock. And it has free cash flow of 37,000 million. And that ties in with what I was talking about, the dividends, where they do have a lot of money to spare and can sustain their dividends over time. However, the CEO has mentioned that they will not be that most their dividends will kind of go back to normal close to mid 2021 or towards the mid to end of 2021. So while people have been saying that the dividend will go back to normal early 2021, the CEO has kind of like disregarded that. The net margin of 2.17, which is quite low, but it has been consistently over 20 since 2012. So that's 12, that's 8 straight years of having a net margin over 20, which basically means that this company isn't losing too much to its competitors and isn't spending too much money trying to sustain its profit. And especially with this tying back into what the CEO was talking about of reducing cost and spending, I'm pretty sure that this net margin will be set to rise, resulting in a more profitable company. And its return on equity is 0.97%, once again due to the skewed data, but has been over 10% since 2010. So although it's not fantastic return on equity like what you'd see with Apple or like other companies or Amazon or Tesla, those kind of things, its return on equity is still quite stable and it is less volatile from those companies, resulting in a more safer bet there. Its debt to equity is 1.35. So normally you want a debt to equity of 0.5, but because it's a bank and the whole business model is in getting debt, which kind of shows a good bank. However, 1.35 is still quite a healthy debt to equity, especially for a bank of this size, being it one of the largest commercial banks in the US. So the financials are pretty strong, purely on the numbers based. So the financial expectations in the future. So the earnings are forecasted to grow 50% next year. But just keep in mind that that is compared to this year. So it's essentially going towards normal, but it's not necessarily a boost from what it was before. So the terminology might be a little bit misinformative there. And it has been listed as having a flawless balance sheet with a moderate growth potential. So, as mentioned previously, it has all its dividend, it has excess cash, it's not spending too much, it doesn't have too much liabilities. So, because of that, it has a very good balance sheet and has moderate growth potential based on the stock price being hit. It has increased volatility this year, but pre COVID, it is generally quite a safe bet with being a bank. And it has a P ratio of 75. This is probably the most skewed data that you can possibly get because of its earnings per share being almost a quarter of what it was before. But generally, its PE ratio over the past 6 to 7 years has been 15, which is significantly cheaper than the US market's average over the last 6 to 7 years of 20. Its PB ratio is 0.7, so essentially it's 30% undervalued based on the intrinsic value per stock. Which is amazing and stands much better than the sector of 1 and the market of 2.1. So it's almost trading at 3 times cheaper valuation than the market as a whole. And while its revenue is set to grow slightly faster than the industry at around 3% a year, the profit is set to skyrocket 150%. But due also that ties in with the new model of selling off its slower businesses and reducing spending, increasing a higher profit even if your revenue is not necessarily growing at the same rate. So just final thoughts. This company and the stock itself are undervalued, and it has been slipping under the radar due to the fact that there's negatively skewed data, and because of this company being over scrutinized. And that has also led to the stock price being pummeled, even though it's been doing almost the same thing as its peers, which are also other big banks that have struggled. But even with all this, it is a very strong company with a flawless balance sheet and is set to increase its revenue and profit quite significantly over the next few years. So I believe this screenshot at the end summarizes this company pretty well. So it's had a rough couple of years with its reputation marred. But despite its problems, it's still one of the largest and most well-established names in the financial sector. And the bank is already on its path to dealing with the regulatory issues that it faced in 2016. I didn't really mention that because it's a little bit of old news. But it's also expects to exit the asset cap with one of its biggest barriers to success. So all these signs, coupled with the analyst positive outlook on the Wells Fargo stocks, leads to a brighter future for the company. But in the end, I still believe that you guys should do your own research should you think about investing. And if you've made this, this far, thank you, and I'll see you guys in the next one. Bye.